I'm Doris and I'm here to share with you about my stock account update and today's market. Today my stock account has earned $18. US stocks closed mixed and good news for falling inflation. The Fed says supply chains return to normal after 3 years of turmoil. So in my account today's PL is 0.02% of gain, and still the total history PL is $27,337.57. Today, SKQ decreased for 0.35% to 36.6, while DRV increased for 1.15% to $46.5. In today's market, we can see that Dow Jones Industrial Average rose for 0.12%, while Nasdaq Composite decreased for 0.11%, and S&P 500 Index increased for 0.07%. Most of the industries closed mixed, with the auto manufacturers decreased for 0.13%, and on the other hand, the tech industries rose for 1.17%. Treasury yields recovered this week. The market focused on the February non-farm payrolls data and testimony from Fed Chairman Jervien Powell. The yield on the 10-year Treasury note reversed the morning downward trend and rose slightly, while the yield on the benchmark 10-year Treasury note broke through the psychological 4% mark several times last week. All three major U.S. stocks indexes posted gains. The Dow rose 1.75% for the week, ending a 4-week losing streak. The S&P 500 rose 1.19%, while Nasdaq rose for 2.58%. The rise in the 10-year Treasury yield increases borrowing costs for consumers and could indicate a decline in investor confidence. Sri Kumar, global institutional analyst, said, "If you are afraid of recession, buying the 10-year Treasury note. The stock market is losing ground today. Don't trust Friday's rally until you see a sharp drop in valuations." This week, the market is focused on some important economic data and comments by the Fed Chairman Jervien Powell. Powell will give a semi-annual testimony on monetary policy in both houses of Congress on Tuesday and Wednesday, and lawmakers will explore how he sees inflation and its future rate hike activity and looks for clues to the Fed's next move. It will be Mr. Powell's last public speech before the March rate decision. Mr. Powell is expected to be like other central bankers in suggesting that interest rates will be higher than policymakers expected a few weeks ago if economic data remains hot. The Fed, writing in its semi-annual report to Congress on Friday, said the bank was acutely aware of the challenges for the economy from high inflation and was firmly committed to meeting its 2% inflation target. The report stresses that the reason for the FOMC to continuously increase the Fed funds rate target within the target range is sufficient or adjust the pace of a balance sheet reduction if necessary. It is expected to be the main issue Mr. Powell discusses with members of Congress. In the recent days, some Fed officials have suggested they may have to do more to curb inflation after a string of strong data on jobs, prices, and consumption. The most important economic data of the week is February non-farm payrolls report, scheduled for Friday. This follows a blockbuster January report showing 517,000 jobs in the economy. Economists surveyed by the Dow Jones on average expect 225,000 non-farm payrolls in February. The New York Fed has released good news for falling high inflation. After 3 years of turmoil after the coronavirus outbreak, global supply chains have finally returned to normal. On Monday, March 6, the New York Federal Reserve's Global Supply Chain Pressure Index was negative 0.26 for February, falling to negative territory for the first time since August 2019, and was revised to 0.95 for January. The New York Fed said the February index suggests a significant drop in pressure on supply chains, and turning negative means that the global supply chain environment has returned to normal after a temporary setback around the start of the year. The Global Supply Chain Pressure Index is the result of the New York Fed's 27 variables, including multinational transportation costs, as well as manufacturing data from China, Japan, South Korea, the UK, and the US. If the index is 0, it represents the flat historical average, with both positive and negative indicating the over average standard deviation. The index fell for 7 of the last 10 months ended in February, reflecting the impact of reduced shipping congestion, easing component shortages, and weak consumer demand. The New York Fed said most of the factors contributed significantly to the February index decline, with the biggest impact being on delivery times in Europe. Media commentators said that supply chain pressures have been a big driver of high inflation in recent years. The New York Fed's February index suggests it was easier and easier to transport goods worldwide, which could help ease price pressures. UBS reported in February that it tracked its composite index of global supply chain pressures as already below normal, falling to its lowest level since 2013, except for 1 month in 2019. In other words, supply chain pressures fell to their lowest level in a decade. UBS believes that global supply chain bottlenecks are gradually easing, and inflation may be approaching an inflection point due to an improved demand imbalance, falling air and shipping costs. But another driver of slow supply chain pressure is not good news for the countries. South Korea, known as the Canary, is repeatedly hit by global economic slowdown. Earlier this month, South Korea industry trade resources exports fell 7.5% in February. Importing increased for 3.6% year-on-year, although the import and export trade deficit from a record high in January, $12.69 billion, narrowed to $5.3 billion. But has been 12 consecutive months recorded deficit since January 1995 to May 1997. Continuous trade deficit after 25 years for the first time, 12 consecutive months of trade deficit. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.